Hello, this is Bear from Wave. How's it going? Here's a new video on dividend stock Kellogg, ticker symbol K. Just like last time, we're going to take a look at the Elliott Wave Analysis, which is what we will mainly do in this video, and then a quick look at some dividend data that is available. So first of all, Kellogg is currently yielding about 4%, and we are sitting at around 32% down of the all-time high, as you can see. So today we're going to look at the Elliott Wave Analysis and see what we could expect in terms of price movement in the future, and how we could utilize that in our favor if we want to perhaps add Kellogg's in our dividend portfolio. Full disclaimer, I'm not a financial advisor. If you're seeking financial advice, please consult a professional. But I do care about saying that I do own Kellogg's in my dividend growth portfolio, but that's not something that because I do, it means that you should also own it as well. So enough been said, let's just dive into the count. Today I'm going to show you two main counts and then a little variant, which are what I would say the most probable count for time being. So I'm going to start with the main count here, which basically forecasts a 1-2 of primary degree in place with the 2000 low, and then ever since we could have rallied into potential wave 3. Now, a problem about this count is that we do stand very close to invalidation level, and in terms of Elliott Wave rules, invalidation stands where wave 4 and 1 overlap. So wave 4 does not seem to be completed yet. It looks like we've had 3 was down into wave A, 3 up in B, and now we're going down for wave C. So as you can see, red line represents invalidation level. If price manages to go below $56.93, this count is going to be valid, and we're going to switch to one of the alternates. Let's assume we will find support soon and turn higher into potential wave 5 of 3, then we can expect at least the 61.8% 3 against 1, and next target would be equality at $173. Obviously, that's not something going to happen overnight, but in the long term, we could look for such targets. Now, one thing that I like to just add is, well, how can you say we get to $800? That would be roughly, as you can see here, over a 1000% move. Well, as I've always said, and as everyone says, when we were sitting at $2, could we ever imagine we would have once reached 60 with a 2700% gain? Same thing stands for 60 to 400. Anyways, let's move on to the alternate here. Here you can see how I am allowing for further down upside into wave 3, so to extend much higher than the previous count. And to do so, I saw a potential 5-wave move into wave 1, and as this correction seems to be taking quite some time, as you can see here, this started in 2016, so it's been currently 7 years. This is a count that I'm going to be considering if we do break previous invalidation level for the previous count, and at that point it wouldn't be even impossible to look for resistance near this wave 4 position. And if we bring in volume, we can see how we do have quite such large amounts of volume, which could act as our point of control, so we could seek those orders and then resume higher. In addition to that, let's bring our Fibonacci tool, and that would also represent around 60, as you can see, spot on 61.8% of the advanced, which is a very common target for wave 2. As some of you may know, if you're into Elliott Wave, that would be a textbook move in terms of wave 2 position. But either way, it looks like if we do manage to move lower, we could easily hit that target. In addition to that, we can also look for equality of the move downs of the two legs. So that would be wave A, B, and see within wave 2 obviously, and equality would stand at $46, and we have next target at 33. So this area would be our zone of support, which includes the previous wave 4 I just mentioned. So that's another target. What does it mean? It means that we could potentially see further downside, and at that point we could resume higher. One thing that I like to say though, this wave 2 position of primary degree, so 1 degree higher of what this count would forecast, was roughly a 60% move. Now we know that usually correction of the same degree will tend towards equality in magnitude. Therefore, as you can see here, I would like ideally for this wave 2 to be shallower than wave 2 of primary degree. Therefore, I actually would prefer if we would stay away from that 60% equality and would aim more towards perhaps a 46% here, which stands at equality, so $46. Now that was briefly the 2 main counts that I had in mind. If you have any questions about those, please let me know in the comments. Now let's take a quick look at some dividend data, which again, I'm not an expert on. There's so many channels out there who do a better job than me. I'm just doing this to support my Elliott Wave analysis. So let's move on to those. So here on the second alpha, we can see consistent growth ever since 2005, which, as you can see easily, it wasn't quite a substantial growth, which is what also dividend growth is telling us. We have a 10-year dividend growth rate at about 3% and 10 years at 4%. So dividend growth isn't enormous. 5-year stands at around 3%, which is still better than no growth at all or dividend cuts. But then again, we saw in our Elliott Wave analysis that we could expect further downside, therefore lower prices, which could increase our future yield on cost. And that would be obviously something that someone who has dividend growth portfolio would look into it. Please consider subscribing to the channel if you want to see more. And please leave a comment what you think about the analysis, what you think about Kellogg, and what you would like me to cover next. Thanks for watching, and I'll see you in the next one.